What if you could get the real inside story on a major energy company's performance? Go far beyond just the headlines to understand what truly drives their massive business.
Well, that's exactly what we're doing today.
Right. We're taking a deep dive into Valero Energy Corporation's second quarter 2025 financial results.
Yep.
Our goal is to basically pull out the most important nuggets of knowledge from their earnings call and that detailed Form 10Q filing they put out.
Giving you a shortcut, really, to being well informed about this multinational energy giant.
Exactly.
And we're going to try and give you that well-rounded picture. We'll start by unpacking Valero's overall financial health, get those big picture numbers first.
Okay.
Then we'll zero in on the performance of their key business segments: refining, renewable diesel, and ethanol. And some surprises there.
Oh, yeah. And crucially, we'll connect all this to the strategic landscape, the future outlook, especially with some, well, fascinating new legislation that just landed. Ready to dig in?
Let's do it.
Okay, let's look at Valero's top-line numbers for Q2 2025. What do they show? Well, net income attributable to Valero stockholders came in at $714 million. That's 2.28 cents per share.
Right. And for context, that's a dip compared to Q2 2024.
It is.
Last year was $880 million, or 2.71 cents per share. So a noticeable decrease.
And this dip in net income wasn't isolated, was it?
No, not at all. The total company operating income also saw a decline. It reached $997 million in Q2 2025.
Okay.
That's down from $1.221 billion in Q2 2024. So you're looking at a $224 million decrease in operating income, which, as we'll see, it kind of hints at some significant shifts and maybe some headwinds the company faced this quarter.
But okay, despite that overall drop, what's really noteworthy here is their cash flow. Valero generated a pretty robust $936 million in net cash from operating activities in Q2 2025.
That's solid.
And here's where it gets interesting, demonstrating their financial, let's say, agility. After you account for an unfavorable impact from working capital, basically, how cash moved around in their day-to-day ops.
Right, the timing of payments and receivables.
Exactly. And the other joint venture member's share of Diamond Green Diesel, their adjusted net cash from operating activities actually hit $1.3 billion.
Wow, okay. So that adjusted number is key.
It really is. It's a powerful sign of underlying strength, I think.
It truly is. It underscores their ability to generate significant cash, even when facing, operational challenges.
Yeah.
And what really stands out, connecting this to their shareholder commitment, is how much they returned. A substantial $695 million just in Q2.
How did that break down?
Well, it was $354 million in dividends and another $341 million in stock buybacks.
Okay.
They actually purchased about 2.6 million shares. This all translates to a 52% payout ratio for the quarter.
52%. That shows a clear focus on returning value, doesn't it?
Absolutely. And as a signal of continued confidence, just last week, July 17th, they announced another quarterly cash dividend, $1.13 per common share.
Sticking with the plan there.
Yep. And that financial discipline is further reinforced if you look at their balance sheet. Valero ended Q2 with $8.4 billion in total debt, $2.3 billion in finance lease obligations, and a very healthy $4.5 billion in cash and cash equivalents.
That's a nice cash cushion.
It is. And their debt-to-capitalization ratio, net of cash, was a robust 19% as of June 30th.
19%. That's quite low.
It is for this industry. Plus, they had $5.3 billion of available liquidity, and that's excluding the cash.
Right.
So in a capital-intensive business like energy, having that kind of low leverage, it gives them significant flexibility, right, for future investments or just weathering market downturns. It's a real competitive advantage.
Okay, so we've seen the overall numbers, which, suggest some challenges, maybe some headwinds. But here's where the plot thickens a bit. Valero's traditional powerhouse, their refining segment, well, it tells a surprisingly different story this quarter, much stronger. How did that segment actually perform?
Yeah, it's fascinating, isn't it? Despite the overall drop in company net income we just talked about, the refining segment actually reported an increase in operating income.
An increase?
Yes, from $1.2 billion in Q2 2024 up to $1.3 billion in Q2 2025. Their adjusted operating income increased by $41 million. This resilience, I think, is a key takeaway from the quarter for them.
And what's really exciting here, something they highlighted, is that Valero set a record for refining throughput rate in its U.S. Gulf Coast region in Q2.
A record, okay.
Yeah. So even though overall throughput volumes averaged 2.9 million barrels per day, which is actually a slight decrease, about 88,000 barrels per day less than Q2 2024.
Right.
That Gulf Coast performance is a clear highlight. And this record, it isn't just about volume, right? It signals that Valero's earlier strategic investments, optimizing specific units, improving logistics, they're really paying off.
Making their Gulf Coast ops exceptionally resilient.
Exactly. Even as other parts of their business face pressure.
Indeed. And looking at the driving forces behind these refining margins, we saw a favorable impact of about $390 million each from increased gasoline margins and distillate margins.
Distillate being mainly diesel.
Primarily diesel, yeah. So those product margins were strong.
Okay, but that positive impact was somewhat countered.
It was, yeah. There was an unfavorable impact of approximately $450 million from declining crude oil differentials.
Okay, can you unpack that? What does that mean for listeners?
Sure. It basically means the price gap, the difference between the crude oil Valero buys and the refined products they sell, that gap narrowed.
Oh, okay.
So it squeezed their profit per barrel. This often happens due to shifts in global supply and demand for specific types of crude oil.
Got it.
However, the broader market context, it actually shows really supportive refining fundamentals overall. Strong product demand and persistently low global product inventories.
And when you say low inventories, how low are we talking for something like diesel? Because that's been a story.
Yeah, specifically, U.S. diesel inventories and days of supply in early July were at their lowest level for the month in almost 30 years.
Wow. 30 years.
30 years. Think about that for a second. That's a significant detail, highlighting extreme market tightness.
Definitely.
And Valero's quarterly diesel sales volumes reflected that they were up about 10% year over year. Gasoline sales were roughly flat, about the same.
So that tight supply, strong demand, that provided crucial support for their refining margins, offsetting some of that crude differential pressure.
Exactly. Kept those margins relatively healthy.
Now let's talk California, because there's a significant strategic and financial impact happening there. The refining segment saw a $103 million increase in depreciation and amortization expense. What's that about?
Yeah, that increase is directly tied to Valero's plan to cease refining operations at its Benicia refinery.
Okay.
They plan to do that by the end of April 2026. And this isn't just a minor operational tweak,
No, it sounds major.
It is. Back in Q1 2025, Valero recognized a really substantial $1.1 billion asset impairment loss. That's $877 million after taxes.
Wow.
And that related to both the Benicia and the Wilmington refineries in California.
Both of them. Why?
Well, it was a direct result of them evaluating strategic alternatives, given new state legislation there in California.
The regulatory environment strikes again.
It's a powerful example, isn't it? How changing policy and regulations can directly hit a company's financials, their asset values, and really push them to make some tough strategic choices.
Absolutely. So, okay, after that surprisingly robust refining performance, let's pivot now to where the energy landscape is, well, truly evolving their renewable fuels segments.
Right.
And here, the picture gets a bit more complex for Valero, doesn't it?
It does.
The renewable diesel segment, primarily their Diamond Green Diesel or BGD joint venture, well, it reported an operating loss of $79 million in Q2 2025.
A loss, yeah. And that's a significant swing from Q2 2024 when they had operating income of $112 million.
Income to loss. What drove such a dramatic shift?
It was indeed dramatic, primarily driven by a $260 million unfavorable impact from higher feedstock costs.
$260 million just from feedstock.
Yeah, think about that. The cost of the raw materials, like used cooking oil or animal fats, just ate into their margins significantly.
Okay.
And on top of that, there was another $110 million unfavorable impact from decreased sales volumes.
Lower volumes too. Why?
They cited, quote, reduced production driven by unfavorable economic conditions. Sales volumes averaged 2.7 million gallons per day, which was down 760,000 gallons per day compared to Q2 last year.
So higher costs and lower production. That's a tough combination.
It really is.
But there was some mitigation to that loss, right? Something positive.
Yes, a partial offset. It came from a favorable impact of $180 million from higher product prices, particularly renewable diesel itself. So they were getting more per gallon, but not enough to cover the feedstock cost jump and the volume drop. And looking ahead, for the full year 2025, Valero expects renewable diesel sales volumes to be about 1.1 billion gallons. That still reflects those lower production volumes because of the prevailing economics.
Oh.
It really suggests that the profitability of renewable diesel is, heavily influenced by this volatile interplay of feedstock costs, product prices, and of course, policy incentives.
Okay, then we have their ethanol segment. How did that do?
Ethanol reported $54 million of operating income in Q2 2025.
Which is also down, isn't it, from $105 million in Q2 2024?
It is down, yes. But despite that decline in operating income, it's worth noting that ethanol production volumes actually increased.
Oh, interesting. Increased production, but lower income.
Exactly. Volumes were up by 109,000 gallons per day year over year, averaging 4.6 million gallons per day.
Yeah.
The income decline was mainly due to lower ethanol prices and higher corn prices, corn being their primary feedstock.
Ah, the classic margin squeeze again.
Mhm.
Lower selling price, higher input cost.
Precisely. That was partially offset by the increased production volume, but not enough to overcome the price pressures.
So while they produced more, the market conditions for pricing their product and buying their inputs created a significant headwind. Hit the bottom line.
That's the story there, yeah.
So, given these, well, contrasting performances across the different segments, what does this all mean for the path forward? What's the outlook?
Well, Valero themselves, they remain optimistic about refining fundamentals.
Okay, why?
They're citing several planned refinery closures globally this year, plus limited announced capacity additions beyond 2025. They believe this should continue to support high utilization rates for existing efficient refineries like theirs.
So less competition, basically.
In essence, yes,
Okay.
a tighter supply-demand balance.
Right.
And they see demand for transportation fuels remaining robust. Jet fuel, in particular, continuing to improve, approaching pre-pandemic levels, at least in the U.S.
Right.
They also expect sour crude oil differentials, that price gap we talked about, to widen in Q3 and Q4 this year.
Why is that?
Because OPEC Plus and Canada are expected to increase production of those types of crudes. And if that spread widens, it could be quite favorable for Valero's refining segment, improving their margins.
Okay, makes sense. Beyond the market dynamics, is Valero making any specific strategic investments we should know about?
They are. They're progressing with an FCC, that's Fluid Catalytic Cracking Unit Optimization Project, at their St. Charles refinery.
Okay, what does that do?
It's a $230 million project expected to start up in 2026. The aim is to increase the yield of high-value products, including high-octane alkylate.
Alkylate, that's a key component for premium gasoline, right?
Exactly. So upgrading their capability there. And looking at their overall capital allocation, Valero projects total capital investments attributable to them for 2025 to be about $2.0 billion.
$2 billion. How's that split?
About $1.6 billion is allocated to sustaining the business, maintenance, keeping existing assets in top shape.
Okay.
The balance, about $400 million, is earmarked for growth projects like that FCC optimization.
Right. So balancing maintenance with strategic growth.
Which is vital, yeah,
Look
for
like-
long-term strategic positioning in this industry.
Now let's talk about something potentially big. New legislation. The One Big Beautiful Bill Act, or OBBB. That was enacted on July 4th, 2025. It sounds like it has several key provisions that could really shake things up in the energy sector.
Yeah, this act is definitely important for understanding the evolving regulatory landscape. So the OBBB, it extends the clean fuel production credit, which is good news for producers, out through December 31st, 2029.
Okay, an extension.
But, and this is a big but, it introduces a critical new requirement. Feedstocks for clean fuel produced after December 31st, 2025. So starting next year.
Yeah.
They must be produced or grown exclusively in the U.S., Mexico, or Canada to be eligible for that clean fuel production credit.
Exclusively North America. Wow, okay, that sounds like a potential game changer for supply chains, right? If companies were sourcing from elsewhere.
Absolutely. It could significantly shift where companies get their feedstocks for things like renewable diesel or SAF.
What else is in this OBBB Act?
Well, it also eliminates the special higher clean fuel production credit rate for sustainable aviation fuel, or SAF, produced after December 31st, 2025.
Eliminates the special rate for S.
Yeah, so less incentive there specifically for SAF after 2025 under this credit structure. On the flip side, though, something positive for capital investment.
Okay.
It permanently reinstates the provision allowing companies to expense 100% of the cost of qualified property acquired and placed in service after January 19, 2025. Full expensing is back.
Oh, 100% bonus depreciation, basically.
Yeah.
That's definitely a benefit for capital-intensive companies like Valero.
For sure. It lowers the after-tax cost of investments significantly.
So, okay, big changes in this bill. How does Valero expect this sprawling new act to impact them specifically?
Well, interestingly, Valero stated that they do not expect the OBBB to have a material effect on their financial position, results of operations, or liquidity in 2025.
No material effect in 2025. That's fascinating, isn't it? Given the scope, especially the feedstock requirement kicking in next year.
It is fascinating. Their resilience here might hint at, how well hedged they are against these kinds of policy shifts, maybe through their existing supply chains or diversified portfolio.
Or perhaps it suggests the legislation's immediate bite might be felt more later, or by others less prepared than a giant like Valero.
Could be. It's definitely something to watch how that plays out beyond 2025.
Finally, one last piece. Regulatory costs. These seem to be becoming a bigger and bigger factor across the energy industry. What was the cost for Valero this quarter?
Yeah, the cost of complying with renewable and low carbon fuel programs, things like purchasing compliance credits, RENs in the US, that cost was $408 million in Q2 2025.
$408 million. How does that compare?
That's a significant increase from $173 million in Q2 2024.
Wow, it more than doubled year over year.
It did. This jump really highlights the increasing financial weight of these low-carbon fuel mandates on companies like Valero. It's a direct expense that hits profitability.
And it signals the increasing stringency and cost of meeting these evolving fuel standards.
Absolutely. It's a growing part of the cost of doing business.
Okay, so as we wrap up this deep dive, we've seen Valero Energy demonstrate, really strong operational execution in its traditional refining segment. They even set records there.
Yeah, it truly highlights where their core resilience lies right now.
Right. But overall, profitability definitely faced headwinds from various factors. We saw higher feedstock costs and those unfavorable economic conditions hitting their renewable diesel segment pretty hard.
And don't forget that significant asset impairment charge related to the California refineries, that was a big hit earlier in the year, affecting the year-over-year comparisons too.
True. So what stands out for you, the listener, is how Valero is clearly investing strategically in both traditional fuels and low-carbon fuels.
They are. But with the renewable diesel segment currently facing these economic challenges, leading to reduced production,
Yeah.
and with new legislation like OBBB altering clean fuel credit eligibility and feedstock rules, well, it raises an important question, doesn't it?
You get this.
What does all this signal about the real-world economic viability and maybe the near-term future direction of the energy transition for major players like Valero?
Exactly. How will that balance Valero's traditional market strength in refining versus these evolving policy landscapes and tricky economic realities in renewables? How will that shape their long-term strategy?
And indeed, how will it shape the broader energy landscape that we're all watching unfold?
It's certainly something to consider, something to keep an eye on as the industry continues its very complex transformation.